The country can have an increased surplus in its balance of trade as a result of blank. So in this question, we're told to identify which of the following answer choices would result in an increased surplus in a balance of trade. So, option choice A says an increase in domestic inflation. This is incorrect because an increase in domestic inflation means that the price of domestic goods has increased, and because the price of domestic goods has increased, the number of exports will decrease, as foreign countries would not want to buy items or goods and services from that country as their prices are higher. And because they're buying less, that means that exports will decrease. And because exports decrease, surplus will decrease. Now with this, we can eliminate option choice A, because this would not result in an increased surplus. B. Declining imports and rising exports. This seems to be the correct answer, because a surplus is defined as exports being greater than imports. So we can increase this surplus by increasing the exports and decreasing the imports, meaning that the exports would be even greater than the imports, and thus the surplus would increase. So B seems to be the correct answer. C. Higher tariffs imposed by its trading partners. This is incorrect because higher tariffs would mean that the cost of goods in that country would be greater, and other foreign countries wouldn't buy as much goods from that country because those goods are more expensive. So exports would decrease, and the gap between exports and imports would be smaller. The surplus would decrease. So C is incorrect. D. An increase in capital inflow. This is incorrect because an increase in capital inflow means that the currency is appreciating, and because the currency is appreciating, it means that the value of that currency is greater compared to other currencies, and because of that, it takes more of other currencies to account for or to equal that currency. So therefore, their goods are more expensive than other goods. And because of this, exports would decrease because foreign countries would look for the cheaper goods. So D is incorrect. E. An appreciating currency. This is incorrect because, like D, an appreciating currency would mean that the currency was worth greater or worth more than other currencies. Because of that, their currency is more expensive, and so importing goods from that country would take more currency or be more expensive. Because of that greater expense, the other foreign countries would import less goods from that country, and therefore there would be less exports and greater imports, so there'd be lower surplus. So E is incorrect, and thus the correct answer is B.